afternoon. My name is Larissa Fritula, and today we're presenting for Saratoga Library on Proposition 19 and how to mitigate the impact of the new law that has passed in 2020. I am a certified financial planner and also a certified divorce financial analyst. We'll be talking today on the financial impact, legal impact, and tax impact based on Proposition 18 new rules. Let's first talk about a few housekeeping items. Please keep your questions to the end. I'll answer all the questions that we will have at the end of the presentation. If you have any additional questions, I'll be happy to answer, and my contact information will be at the end of the presentation available for you. Let's talk about Proposition 13 first, that was established a while ago in 1978, and it established two different limits on how much property can be taxed and also how reassessment value will grow. So the first is that the property will not be taxed more than 1%, about 1% of the assessed value in California. And also the property reassessed value, which will be used to base taxes on, will not go up more than 2%. And we'll have a description and also example later on to show you how this reassessed value actually works. Your property value are only reassessed back to or to the fair market value when it's either sold or it's going under new construction. It goes up to the fair market value, and then the property tax will be based on that amount. However, there's a couple of exclusions. One of them is parent-child. If the property is passed to the child, the previous law, the child takes an ownership, and it doesn't matter what the child does with the property, he or she carries a low-cost basis. There are some changes which we'll talk about in Proposition 19. From grandparent to grandchild with similar rules. Seniors, when they moved around within certain counties previously, they also can carry their basis. There are some rules involved on the property value, and we'll talk about it. Also, people with disabilities and natural disaster that's affected California a lot due to wildfires, there are some exclusions to that as well. So now let's discuss what changes has been made and how we will approach the reassessed value going forward. Let's first talk about the terms, market value versus assessed value. So market value is the value the property can be sold at a particular time. And it's usually the value that easy to identify because we can see comparables in the area. We can also see how many buyers coming to buy a property, what they're willing to pay. So the market value is a different value than assessed value. Assessed value usually at the value of the property at the time property was sold or bought. So I buy a property and now I have the value been established. That becomes my basis. We'll talk about base year value. And now I will be paying property tax based on what the property I purchased for. So how Proposition 19 affects new property tax and how we will be calculating them. So starting November 2020, when the law has passed, California voters approved Proposition 19 that became effective February 2021. So they gave us very little time to do any planning or execute any changes because it became a law pretty quick. It changes the provisions of the parent-child and grandparent-grandchild exclusions. There are some limitations on that now, and also adds new provision to the base year value transfer of the primary residence for persons at least 55 years of age or severely disabled or victims of wildfire or natural disaster. So they're giving, they expanded how you can transfer the property if you yourself selling a property and buying another one within the state of California. So they expanded, not counting all 19 different counties, but they said you can do it within the entire state, the purchase of a new property, and still can carry your cost basis with you. Let's talk about parent-child child and grandchild exclusion that changed dramatically, and that's why it's created a lot of emotional impact for people, and we'll talk about if it makes sense and how we will approach it. So first of all, previously, if the property is inherited by a child or grandchild, it can carry the low property tax basis regardless what you do with the property. Now, the child has to consider this property a primary residence or a grandchild in order to maintain the property low property tax. Also, the value will be limited to a current taxable value plus $1 million. So in California, in places where the property values go over 1.5, $2 million, and etc., we will see potential some reassessment might apply, and it will be adjusted annually. Family homes and farms are included in this reassessment, and no longer can other real property be excluded other than principal residence and family farms. So that's very limited, only primary residence, not the secondary homes. You must claim homeowner exemption, that's $7,000, or be disabled veteran that filed within 1 year of transfer. So you have to really make sure that's your primary residence. Now let's talk about the numbers and how it looks. Let's say you bought a property for $500,000 year one, the market value was $500K, and you established the Props 13 base year of your change of ownership, right? So we have $500,000, and that's our market value. So now year two, what happened is we assessing on this, market value raised above the cost basis. Let's say the market went up higher than assessed value. So if we're talking about 1%, next year, year two, your base will be 510, but the market value of the property went up. Let's give an example, 2005, when the property value went up a lot, like similar to was in 2021. And now our assessed value is below the market value. Now moving forward, years 3, 4, and 5, the property value tanked. Recession, 2008, 9, when the property value went down, they were down and depressed for a number of years. However, we didn't see the reassessment went down. It stayed that level, and it was just going up. If you apply for reassessment and you will give comparables to your county assessor showing that the property value indeed has dropped, then potentially you could have a reassessed value decrease somewhat. And if you didn't do it, it could continue to grow. So base factor years grow by 1% regardless. And then the property recovered, and 2011, 2012, in California, the property values start to surpass again the reassessed value. And then you will see a jump in year, if the property value stayed flat and there was no reassessment done and add of additional 1%, you will see an increase in the property reassessed value more than 1%, and you would wonder why. And this is why. If you haven't had any reassessed value increase in the last 5 years, and your third market value eventually went up by 5, 6, 10%, like it did this year, you will see county catching up that extra 1% they didn't charge you for the previous 5 years. So that's the only time when they can say, yes, previous 5 years, we didn't increase your property tax because property value went down. Now we will catch up on all of those extra 1% that we haven't taxed you, and we'll increase it to the level that we can, considering this last 5 years of 5% increase. So that's how it works. So the good news that you capped at 1% increase year after year after year, and you potentially can argue or dispute the value if the values, fair market values indeed dropped, and you also protected from not paying more than 1% a year. 2% a year increase. That's what I meant. 2% a year increase is the maximum number that you can pay on annual increase in your property value. So people who lived in California long enough, we know that average inflation rate on California is properties are probably 3.5%, sometimes 4.5%, 5%, depending on the area. So you've seen that the fair market value is by far greater than the assessment value for your property tax purposes. Proposition 19, value limit tests. This is a very interesting example we'll go over. Will help you understand how potentially your property can be reassessed once you're gone. And then let's talk about this example. So at the time of the transfer, a single family residence has a factor-based year value. Let's call it simply assessment value of $300,000. And the fair market value of the property is 1.5. So the time of the transfer, when the parent passed and property transferred to a child, we'll calculate the sum of the value of the assessed value plus the $1 million allowance. So you excluded amount, they call it, will be 1.3. Now, since the fair market value is greater than the excluded amount by $200,000, the difference will be added to your tax base of $200,000, so your new taxable value will be $500,000. So basically, any difference between fair market value and that excluded amount, which is your current basis plus $1 million, will be that difference that will be added to your low cost basis to come up with the new cost basis after the transfer of the property. It's changed dramatically because previously you could have just carried $300,000 base without any readjustment or reassessment. Now we're looking into this reassessment. Let's exaggerate example. The property value is $2.5 million, not 1.5. Now the difference will be much greater, right? Because it will be 2.5 minus 1.3. So the difference will be much more significant and your reassessed value will be much greater. So Proposition 19, base year value transfer for people over 55. So previously you can only transfer within certain counties in California to maintain your low property tax basis. Now you can transfer it anywhere in California and you can do it up to 3 times. So you can move a lot and still maintain your low cost basis for your original property. However, you need to be careful not to buy a property the greater value, because if you do, that amount will be added to your reassessed value. So it's the same value of the property of the original home or less. You must apply for a taxable value transfer with the county assessor where your new replacement home is located. It doesn't transfer automatically. You need to make sure you carry it with you. New Proposition 19, base year of value transfer for victims of wildfire natural disaster. It's a very new addition to the law, started April 1st, 2021, and it allows people who lost their homes due to wildfires, and that was their primary residence. If the wildfire substantially damaged more than 50% of the improvement value of the residence, then you can transfer your property value anywhere in California and maintain your low basis. This is a great relief to those who lost their homes, and they can relocate without worrying about paying higher property tax. Let's talk about planning opportunities. One example would demonstrate how we can approach it. So Cecilia bought a $2 million property condo in Santa Barbara County in October 2020. And she planned to move there and make her primary residence after she sells her home that she's been for 30 years in Palo Alto. And that home basis is $300,000 and the value is 2.5. So she definitely will be a great example of transferring the value and maintaining a low basis. She has not sold her home yet. Since Santa Barbara County previously didn't participate in the property tax transfer basis. Now it does. She will wait till the new law goes into effect, which is now, and she has 2 years to make a transaction. She can sell a property now and buy a new property 2 years down the road, and still can continue maintaining very low property tax basis. So that gives someone an opportunity to, let's say, not to do a transaction immediately between sell and buy. They can sell, wait a little bit, and then buy it back. But they have 2 years only to do that. You can also do opposite. You can buy a property and sell your existing home. And now, because we don't have a county restrictions, you can buy it anywhere in California. Opportunities are limited, I have to say, because this Proposition 19 was passed so quick. Not too many people had a chance to do anything about it. But the reality is, statistically, 90% of the time when children or grandchildren inherit the property, they do not live in the property. They either rent it for rental income, they make it their second home, vacation home if it's a nice area, or they sell it. So even though we know that now, in order for the child to maintain a low-cost basis for the tax purposes, he or she need to stay in the property considered as the primary residence. In reality, a lot of children didn't stay. So they would sell the property. And because of that, that was not a big impact on the coming generation, on children and grandchildren. Where the biggest, let's say, disadvantage of this current law is that reassessment value has to be adjusted based on the difference with the $1 million excluded amount that we just went over. That makes a huge difference. If someone does stay in the property and they will not be able to just maintain that low cost basis, there will be $1 million plus the cost basis, and the difference between fair market value and that amount will be the amount will be added to the existing cost basis of the property. Let's look at a couple other examples. Ted, Carol, and Alice own a property in partnership and contribute their respective ownership interest in the property to the partnership for the same proportional interest without triggering reassessment. So because no one owns the property more than 50%, let's say the property is transferred and anyone in the ownership does not have more than 50% ownership of the original owner transfer. Because of that, there is no reassessment triggered. If a property is transferred from one person to the other and one of the receiving person has more than 50% ownership, the reassessment will be triggered. But because they own 30, 40%, there is no reassessment. Let's say the future date, Ted and Carol, who owns 30 and 30%, can each purchase 1/2 of Alice's 40% value in partnership interest. And since it's still less than 50% for each of them, it becomes also as of the original co-owner interest was transferred, on the original co-owner rule, there is still no reassessment of the property. So as long as you follow the rule that you do not take original owner's percentage into your possession as the inheritance more than 50%, then there is no reassessed value. So we need to be careful how we place our properties in trust and who is getting the properties and what values. So again, we're not talking about parent and child, we're talking about some other people, let's say siblings. There is no rule for siblings to have exclusion, or there is maybe rules for companies that come in, family partnership that come in and own the properties after the original owner passes. So the ownership needs to be of each person less than 50%. Legal entity exemption. Steve and Helen have decided to form an LLC. They will use the LLC to purchase an apartment building in San Francisco. They both can give their interest in the LLC in equal shares to their 2 children. As long as no one person or entity gets more than 50% control of the entity, the property owned by LLC will not be reassessed. The similar idea. They can grant an interest to 3 people and break it down as 33%. But as long as neither of the child owns more than 50%, let's say 51, 52 plus, then there is no reassessment on value. Now what we'll do is I'll address some questions, making sure that whatever we discussed has some meat to it, and we will put it into Q&A to test some of the knowledge we just received. Is it possible the law will change or be repealed? Very possible. Every time there is a new presidency come, new legislation usually passes on, and it is possible it's not going to stay there the way it is forever. There might be some changes to Prop 19, but as of today, we know law has passed and it's in effect, so we need to follow and abide to it. But it is very possible it might change. For the parent-child exemption on reassessment, does the child have to already be living in a parent home before the transfer, or can the child still qualify if they move after? The answer is yes. Child does not need to be living in the property. Child can take possession of the property as the primary residence after estate administration has been done and child has a legal possession of the property. They can move in later on and still keep the low cost basis as long as the child consider this property as the primary residence. Does it make sense to put an existing home in an LLC now it is too late? Does it work for new purchasers only? Ideally, you put your property, especially on the rental properties, in order for yourself to protect your assets, you need to, most cases, to create an LLC and put your rental properties in LLC. So if the renter sues you for any reason, they sue an LLC, not you, because LLC owns the property, not you personally. So your personal assets are protected. I would like to disclose that I'm not an attorney, I'm a financial planner. So any legal questions need to be addressed to your state attorney, your property casualty attorney, but I know the basics, and today we talk about the financial planning aspects of it, not legal aspects of this Proposition 19. What are the changes at the time when people voted on it were carried through the legislation as the positive impact, and somebody is saying that it was very confusing for people to vote on. I agree, it was quickly done, and a lot of people didn't realize the impact of it till later on. The people who voted for it obviously wanted to have a chance to move around within the state freely. That would allow them to carry their low cost basis with them. And the age group is 55 plus. So we need to remember that, and also giving some flexibility to those folks who want to move around after they retire. What is your opinion on people who have not done anything last year, which most of them didn't? And example is the couple of in their 60s and 70s who have long-term property worth over a couple $1 million. The reality is that you can still do certain planning when you have a knowledge that you don't want to give to any particular person more than 51% ownership in order to trigger reassessment. You can consider that. You also can consider if the property is going to be probably eventually sold, what's the best way to put it in your estate? Maybe you make a plan where the property is given to 2 people to manage and consider reassessment and value, or it can be sold upon a second trustee death and proceeds distributed equally among the beneficiaries. So now, since we know the law is different, we can readjust and reassess our estate plan based on our goals, at the same time thinking about how we lower taxes if possible. But passing your property to the next generation and not giving them outright while you're living has a huge advantage, which is still there, is the step up in basis. Now we're talking about no property tax, we're talking about capital gain tax. So if you gift your property to your children, to your heirs during your lifetime, they carry a low cost basis for capital gain tax purposes. When you give it to them through the inheritance process, the inheritance allow the property value to go up to the fair market value, and when children sell it, they will not pay all the capital gain tax. That's still current law, and it's still a huge advantage for you to pass all these properties to children after you pass, to take advantage of the step up in basis. My homeowner insurance company wants to reassess home value for coverage. Does this affect taxes? No, the answer is not. The reassessment that the property and casualty insurance is doing every year has no effect on your property tax whatsoever. So that seems to be all the questions that we have. And if there is no additional questions, I'm going to stop and let you know that we're available via email, and you can always ask me at larissa.ritula@lpl.com, and I'm happy to answer any questions regarding financial planning around Proposition 19 or any questions you do have as the follow-up. Thank you very much and have a wonderful day.